Hi, I'm Scott Powell, and welcome to CFI's Accounting Fundamentals course. I am so glad you're here. If you're a financial analyst or just looking for a refresher on accounting, this is the perfect course for you. Trust me when I say understanding accounting is the key to understanding finance. We're going to deep dive into the fundamentals of accounting and show you how it can give us invaluable insights into a business's profitability, operations, growth, and much more. It's truly the backbone of any successful financial analysis. Now, you might be wondering what we're going to cover in the course. We're going to start with the balance sheet and explore how to record transactions on the balance sheet. Then we'll move to the income statement and explore how to put transactions through the income statement. Finally, we'll build a cash flow statement using both the balance sheet and income statement that we created together. But don't worry, we won't just be throwing information at you. You'll start by watching a video lecture, but then you'll participate in a wide range of interactive practice exercises and case studies so that you can really solidify your understanding. Plus, we'll throw in quizzes along the way so that you can test your knowledge. So, what are we waiting for? Let's dive into the world of accounting together and see what we can uncover.
In this chapter, we're going to start by exploring the foundations underpinning accounting, such as, for example, why financial statements are prepared in the first place. And we'll finish this chapter by exploring the accounting equation. Now, to be able to analyze financial statements, it's first really critically necessary to understand them. Financial statements are really simply a method of communicating the financial health and viability of an organization to both internal stakeholders, such as managers, and external stakeholders, such as the bank or shareholders. Accounting is sometimes referred to as the language of business. Throughout the life of a business, the accounting processes are intended to identify, track, and record transactions. Now, throughout this course, we're going to encounter many new terms. Well, I'm going to introduce you to terms like debits and credits and journal entries and even something called the general ledger. Each of these contribute to the creation of a business's financial statements. Now, perhaps I should say organizations rather than businesses, because we will learn that there are many different types of organizations that use accounting. Financial statements are a tool used to communicate the financial performance of all organizations and businesses. The format of the information that is being provided in each of the statements gives the user the ability to not only evaluate performance, but more importantly, make informed decisions. Now, one of the key tasks for financial analysts is the ability then to review those financial statements to support financial or investment decisions. Organizations come in all shapes and sizes, and they can also have a wide range of purposes. For-profit organizations aim to generate revenues and ultimately earn a profit for their owners. Alternatively, nonprofit or charitable organizations operate to generate money, typically in order to fund programs, services, or research. Now, both of these types of organizations rely on accounting, but in this course, we're going to focus on accounting for a for-profit business. Profit-oriented businesses can be structured in typically one of three different ways. Let's start with small businesses. Often small businesses start out as what we call sole proprietorships. These businesses are typically owned and operated by a single person who reports their business income on their personal tax return. Partnerships are usually business ventures that involve two sole proprietorships. For partnerships, each owner reports their business income, their portion of the business income, on their personal tax return. Now, the risk of both sole proprietorships and partnerships is something we call unlimited liability. And what we mean by that is if someone sues them, all of their business and personal assets could be at stake. Now, let's contrast that with companies or corporations, which are separate legal entities and they're owned by shareholders. Now, corporations must file their own corporate tax returns and create regular financial statements. Now, one of the main benefits of a corporate structure is something we call limited liability. So if a company or corporation is sued, shareholders are only at risk up to the amount that they have invested in the company. They cannot be personally sued. Now, CFI actually has a course that focuses on different types of business structures in more detail. I recommend, if you're interested, to have a look at that course. The financial statements are a record of the financial activities of a business. Now, there are 3 key financial statements that we will work through together. So let's have a high-level look at each of these statements. First is the income statement. The income statement is sometimes referred to as the statement of profit and loss, or simply called the P&L. This shows what a business has earned as revenues, what it's paid out in expenses, and what's left in terms of profit or loss for a given period. Now, that period typically will be a year. The balance sheet, also known as the statement of financial position, shows 3 things. First, what a business owns, and we call those things that a business owns assets. What it owes, and we call what it owes liabilities. And then what's left for shareholders, or what's it worth, and we call that equity. Now, where the income statement is for a period, such as a year, the balance sheet is like a photograph or snapshot of the business at a particular point in time, typically the last day of that year. The statement of cash flows shows how a business has generated or used cash in one of 3 different ways: operating activities, investing activities, and financing activities. And the statement of cash flow, like the income statement, is for a period, typically a year. Now that we've had a bird's eye view of the 3 key financial statements, let's dig a bit deeper into the balance sheet. Now, as the name suggests, the balance sheet must balance. And this is predicated on something we call the accounting equation, which is the foundation of all accounting. The accounting equation basically states this: assets must at all times equal the sum of the liabilities and shareholders' equity. To ensure financial statements are accurate, complete, and reliable, the accounting equation, I can't stress enough, must always be true. So let's dig into the accounting equation in a bit more detail and explore what we mean by assets, liabilities, and equity. So fundamental to understanding the financial statements is to understand how they interrelate as it relates to the accounting equation. Now, as we've learned already, companies have assets, and those are things they own. Now, assets can be things like inventory or equipment or property. Assets have something called future economic benefit, which means they have value that can be used to generate profit, or they can be sold off and liquidated to cash. Liabilities, recall, are what the company or business owes. Now, companies can owe amounts to vendors, suppliers, customers, and creditors like banks. Finally, equity is often referred to as shareholders' equity, and you can think of it as the residual value of the company. So imagine this: a company or business could liquidate all its assets and get cash, and then pay off all its liabilities, and the cash that's left would be with the equity. That's why we call it the residual value. Now let's look at owning a home to try and explain the accounting equation in a bit more detail. So let's imagine you have a home that's an asset that's valued at $1 million. But you also have an outstanding mortgage with a bank on your home for $750,000. So that's a liability. Your equity in your home would be the value of the home at $1 million, less the mortgage of $750,000, leaving you with equity of $250,000. In other words, if you sold your house and paid off the bank, you would be left with a residual value of $250,000. Now, over time, the equity of a business will increase through contributions to the business, maybe by issuing more shares or stock, and also by generating revenue and creating profit. Equity will decrease over time from things like increasing expenses or net losses, or through the payment of dividends to shareholders. No matter what happens, The accounting equation must always, always be true. The balance sheet must always balance. So I suspect by now you're probably asking the question, how do we make sure the balance sheet always balances? Well, in essence, we need to make sure that every single accounting transaction, when entered, is balancing the balance sheet. When the transactions are recorded in the financial records of a business, we use something called double entry accounting, or sometimes called double entry bookkeeping. Let's see how that works. As we know, assets are made up of things a company owns. That can range from the most liquid being cash to the least liquid being what we call fixed assets or capital assets. Capital assets include vehicles, equipment, building, and land. Now, capital assets or fixed assets are things the company uses to generate its returns. Capital assets are not the things that a business typically sells on a regular basis. If a company were in the business of selling vehicles, we'd actually call those vehicles inventory rather than capital assets. Now, the asset accounts are listed in order of liquidity. We start with cash, which is the most liquid, and move down to the least liquid. Generally, land and buildings are more difficult to liquidate than vehicles or inventory. Now let's look at the liabilities. Liabilities are listed in the order of the maturity. That is, when do they have to be paid back? Remember, liabilities are what a business or company owes. Now let's turn to the double entry bookkeeping. Asset accounts normally have what we call debit balances. DR is used as the shorthand for debit. This means that when recording transactions related to asset accounts, we debit the account to increase the balance, and we credit the account to decrease the balance. Now, CR is often used as the short form for credit. Now, in contrast, liability accounts normally have what we call credit balances. This means that when we increase a liability, we'll have a credit on the account, and if a liability is decreasing, we will debit it. Finally, we have equity accounts. Equity accounts are further broken down into revenue and share capital. Those accounts have normal credit balances. Equity accounts also include all expenses and dividend accounts. The increase in these accounts has a negative impact on the overall equity, so they have normal debit balances. The higher an expense account or the more dividend paid, the less equity remains in the company.
Okay, now let's practice with our debits and credits. I have two practice exercises for you. I have one called Practice 1, which we'll do together right now. And then Practice 2, I'm going to encourage you do it first. And then when you're ready to debrief, click on the next lesson and I'll debrief that practice exercise with you. Okay, so let's get started. You'll see at the top, I have put here a bit of a cheat sheet in terms of whether something is an asset, a liability, or equity, and what we do if we need to increase or decrease one of these. And so we have assets, of course, things we own, liabilities, things we owe, and then we have equity. And we call that equity has share capital or common shares, but it also includes our revenues and expenses. So the first question we always ask is it an asset, liability, or does it sit with an equity? So we have scenario 1 where we increase cash. Well, cash is an asset. It's something we own. And now that we know it's an asset, when we're increasing an asset, we know that the rule is it's a debit. Next, we have increasing a vehicle. Now, a vehicle is another thing a business or organization can own, so it's an asset. And again, we have increases to this asset, so it's a debit as well. Okay, let's go to the third one. Now we're increasing a loan. Now, a loan is something we owe, so it's a liability. So let's just capture that it's a liability. And when we're increasing a liability, we credit the liability. When we increase share capital, we know that's part of equity. And when we increase share capital, we are also doing a credit.
Now we have one more thing. When we increase an expense, recall that expenses are falling under equity as well. But when we increase an expense, unlike increasing revenue or increasing shares, it is a debit. Okay, so we've had a go together. Now turn to practice exercise 2. I'll just click on that now. Have a go through those 5 scenarios. And once you've had a go, then click on the next lesson and I'll debrief it with you. Bye for now. Well, now let's debrief practice exercise 2. Again, we have the cheat sheet at the top if you need it. And the first question always to ask, is it an asset, a liability, or equity? And then we can think about whether we need to do a debit or a credit. So scenario 1 is we decrease cash. So what is cash? Well, we already know from the first practice exercise, that's an asset. And when we decrease an asset, we credit it. Next, we decrease a loan. Now recall, a loan is something we owe. It's a liability. And we're decreasing a liability, so that is a debit. Now we go to increasing revenues. Recall that revenues falls under equity. And when we increase revenues, that is a credit. Number 4, the fourth scenario is we're decreasing equipment. Now, equipment is something a business can own, so it's an asset, but we are decreasing equipment, so that is going to be a credit. And finally, we're decreasing share capital. So for example, maybe an organization or company is buying back its shares. When we decrease share capital, we know that's part of equity, and we know, therefore, that is a debit. Congratulations, we've now had a bit of practice with debits and credits.